We got Mike Gibbs, Raymond James Managing Director of Equity Portfolio and Technical Strategy, as well as Chris Constantinos, Riverfront Investment Group Chief Investment Strategist, taking us to the closing bell. But we got Jared Blickery, who's there on the floor of the New York Stock Exchange. Jared?
Yes, that is right. And tech has been the story of the day. We make it the mega caps because tech and communication services, the best performing sectors, energy, the only one in the red, at least the last time I checked a couple minutes ago. That has to do with crude oil being down. Those sanctions on Iran might be lifted, and so that means more oil supply, lower crude prices potentially. But other than that, it's really a day when we saw the 10-year T-note yield down about 4 or 5 basis points, and so those value and cyclical trades were the laggards, kind of par for the course. And guess what? It's 30 seconds to the bell, so you're going to be hearing applause. This happens every day. I'd forgotten about it, but I'll tell you what, we got the VIX now kind of putting in a floor around 20. I think that's really interesting to look at going forward, especially coupled with the low liquidity of the summer. Is it a new epic? We'll have to see, but here's the trading bell, the final bell.
And that does it for the trading day today. Again, as Jared was just saying, stocks rebounding from the losses that we've seen over the last couple of trading days. Technology leading the way sector-wise. Technology communication services there outperforming. You can see it across your screen with the NASDAQ closing up 1.7%. We have the S&P up just over 1%, and the Dow well off its highs of the day, but still registering a 186-point gain. We want to bring in Mike Gibbs and Chris Constantinos to help us make sense of some of the action that we've seen recently. And Mike, I guess from a technical standpoint, when you take a look at some of these levels that we've been brushing up against, at least to the downside over the last several trading days, do you think we've hit a bottom, or do you think we could potentially see more selling over the next couple of weeks?
Well, obviously that's left to be determined, but I would think that the reversal we saw yesterday and the follow through we're seeing today, especially with it coming from near the 50-day moving average, that I think we probably escaped a breakdown this time. I think the market probably has a chance to keep rallying from here, but to see additional follow through over the next couple of days would really build the case for that.
Chris, you're advising people overweight equities right now, but overweight U.S. over international. But wouldn't the international equities have further to run, given the fact that they haven't had the speed of recovery and that the U.S. has?
Well, I think you bring up a good point. Theoretically, yeah, they should have further to run. I could also have made that case at any point in the last decade, right? Because international valuations, there's a lot more potential positive mean reversion there than in the U.S., but it just hasn't manifested itself. We actually wrote about this a few weeks ago in our weekly view. The U.S. is still the economic king of the hill, in our opinion. They were stronger. That country was stronger going into the pandemic. It was stronger coming out of the pandemic. And also the corporate sector of the United States is just a lot more flexible and dynamic, in our opinion, than, say, Japan's or Europe. So while I agree with you in theory, and it may indeed in the near term play out that way, our view is you still, from a secular perspective, you still want to be overweight the United States. It doesn't mean we're not watching international closely. We did trim our emerging markets and Japanese exposure last week. But we have noticed from a technical perspective, and I'd love to get Mike's opinion on this as well, we have noticed the very early stages of Europe starting to do a little better versus IFA and even versus the United States. So that's something we're watching relatively closely because we are seeing a pickup in some of the fundamental data in Europe. Obviously, the UK has done every bit as good a job of vaccine distribution as the United States have, and you can kind of see that in their PMI surveys, their manufacturing surveys. So we are watching Europe relatively closely.
Mike, what do you think, U.S. versus international, specifically Europe?
Chris and I are on the same page there. I think that currently it's U.S., but I would agree with him that we're watching Europe rather closely. And what we tend to focus on is European banks, the relative performance of European banks versus the ACWI Global World Index. And it's actually improving. It's starting to improve just a little bit. We haven't got a breakout yet. If you think about it, it makes sense. Europe's behind with the reopenings. Their economic picture is a little more challenging at this point in time, but they've been left behind in terms of stock performance. So as the world reopens, as more people get vaccinated, as the outbreaks cease there, as they reopen their economies like we're doing, I think that Europe's probably going to set up and give us a pretty good trade to do some relative outperformance versus other areas. But for now, I do agree with Chris. I think it's premature and it's too early for that. but it's something that investors should be keenly watching because I think you're going to get that opportunity.
Mike, real quick, as gold closed down today, but you point out that the gold and silver miners look stronger. You said possibly because of consolidation among the mining companies. Could it also just be the demand for gold, not necessarily for jewelry, but in manufacturing is going to pick up as the global economy picks up?
Yeah, that could be. I also think it's a function of the dynamics that are going on in the market. You know, with commodities being strong as they are, investors are trying to seek any area that they can get exposure there. And gold is an area that gives them that exposure. The best way to play it, you know, for a true equity investor, if they don't want to go long the commodity itself, is to get the miners. And I think that's why they're performing a little bit better and probably have the potential to continue to do that if we see this dynamic of commodity outperformance in the coming months, which we probably will.
So, Chris, you're overweight U.S. relative to international. What specifically in the U.S. are you favoring?
Yeah, right now we have a bit of a barbell on. So there's certain parts of growth that we like, certain parts of value. You know, Mike was talking about European financials. I think a similar dynamic is playing out in the United States, where you've gotten a strengthening or a steepening, of the yield curve, which is classically good for financials. Also, on the growth side of things, while we're not favoring the really, high-flying, super high valuation tech, we are still finding some interesting values in the more unsexy parts of tech. You know, some of the software and services companies that aren't growing quite as fast, but are generating huge free cash flow, and we expect to continue to for them to do that on a secular basis. So we're really not going too heavy into growth or value as a theme right now. It's more we're trying to get more granular within those themes. Be relatively neutral overall growth versus value and be a little bit more picky within that.
All right. We want to thank Chris Constantinos, Riverfront Investment Group Chief Investment Strategist, as well as Mike Gibbs, Raymond James Managing Director of Equity Portfolio and Technical Strategy. See you next time, guys, and thank you for being here.